Welcome to the California housing market in 2026, where the dream of owning a home is starting to feel less like a goal and more like a gamble. For years, the formula was simple: buy property, wait, and watch it grow. Prices climbed, demand never seemed to slow, and no matter how expensive things became, someone was always ready to pay more. But now, something has changed. Homes are sitting on the market longer than they have in years. Price cuts are becoming more common, and buyers who once rushed in with aggressive offers are stepping back. Quietly, cautiously, waiting. This isn't panic, not yet, but it is hesitation, and in real estate, hesitation is where every downturn begins. Today, we're taking a deep road trip across California, exploring 10 cities where the warning signs are becoming harder to ignore. Not hype, not fear, just the patterns and what they could mean next. Think of this as a map of pressure points. Each city tells a different story, but together they reveal something bigger, a market that may have gone too far and is now starting to correct. We begin in Sacramento. Just a few years ago, Sacramento was one of the biggest winners of the pandemic housing boom. When remote work exploded, people left expensive coastal cities and searched for something more affordable, more spacious, more manageable. Sacramento became that destination. Home prices surged, neighborhoods transformed almost overnight. For a moment, it felt like a permanent shift. But the truth is that growth wasn't built on Sacramento's own economic strength. It was built on outside money, on higher salaries imported from other regions. Now that dynamic is changing. Companies are calling workers back, fully remote roles are shrinking, and suddenly, location matters again. Demand is cooling, inventory is rising, sellers are adjusting expectations. Sacramento isn't collapsing, but it is being tested, and when a market grows faster than its foundation, even small changes can expose its weakness. Next stop, Irvine. Irvine is one of the most polished, controlled, and carefully designed cities in the country. Everything feels intentional: clean streets, planned communities, strong infrastructure. It's not just a city, it's a system. And for years, that system delivered stability. But stability comes at a cost. In Irvine, the challenge isn't just the home price, it's the total cost of ownership. Property taxes, HOA fees, and ongoing expenses combine into a long-term financial commitment that pushes affordability to its edge. At some point, even strong markets reach a limit. When fewer buyers can qualify, demand naturally tightens. Homes don't move as quickly, listings stay active longer. That doesn't mean Irvine is weak, but it does mean it's becoming more sensitive to pressure. Now we head south to San Diego. On the surface, San Diego looks untouchable. The lifestyle, the weather, the coastal appeal, it's everything people want. But beneath that appeal lies a growing imbalance. Home prices have reached levels that most local residents simply cannot afford. That creates a market supported by a shrinking pool of buyers. And when that pool gets smaller, stability becomes harder to maintain. Even a slight increase in interest rates or living costs can reduce demand further. San Diego remains desirable, but it's stretched, and stretched markets don't need a major shock, just a shift. Next, Oakland. Once considered the more affordable alternative to its neighbor, across the bay, Oakland attracted buyers looking for value. But today, the conditions are different. Commercial activity has slowed. Office spaces remain underused. Fewer workers are commuting into the city. That impacts everything: local businesses, employment patterns, and overall confidence. And confidence plays a huge role in real estate. When people feel uncertain, they wait. And when they wait, the market slows. Oakland is not collapsing, but it is navigating a period of adjustment. Now we move inland to Riverside. For years, Riverside represented opportunity, a chance to buy a home at a lower price while staying within reach of major cities. But affordability has shifted. Prices rose quickly, interest rates followed, and the cost of ownership climbed. Add in long commutes, rising transportation costs, and time lost every day, and the equation becomes more complicated. Buyers are thinking more carefully. Homes are taking longer to sell. Price reductions are becoming more visible. Riverside didn't solve the affordability problem, it postponed it. Now we arrive in Los Angeles, one of the most complex housing markets in the world, a mix of luxury, global demand, and massive scale. But even here, conditions are evolving. Changes in policy, rising ownership costs, and increasing uncertainty are slowing activity, especially at the higher end of the market. Insurance costs are rising, availability is shifting, and buyers are becoming more cautious. When uncertainty increases, movement slows. And when movement slows, prices eventually respond. Next, San Jose. At the heart of Silicon Valley, San Jose's housing market has long been driven by the tech industry. High incomes, stock-based wealth, rapid expansion. But that environment is no longer as strong as it once was. Hiring has slowed, layoffs have made headlines, and remote work has reduced the need to live close to the office. That shift matters, because when demand tied to a specific industry weakens, the housing market tied to it also changes. Prices may remain high, but without momentum, they become harder to sustain. Now to Palm Springs. This market operates differently from most. Many properties here are not primary homes, but investments, vacation properties, rental units, second residences. That works well when the economy is strong. But when conditions tighten, these are often the first assets to be sold. Rental income becomes less predictable, carrying costs rise, and demand softens. That combination puts pressure on the market. Next, Long Beach. Traditionally more affordable than nearby coastal cities, Long Beach attracted buyers looking for value. But prices have increased here as well. Now the city sits in a difficult position, less affordable than before, but not positioned as a premium market. At the same time, its economy is closely tied to broader regional trends. When those trends slow, demand follows. And finally, San Francisco, one of the most iconic housing markets in the world, but also one of the most complex right now. Office spaces remain underused, population patterns are shifting, work habits are evolving. All of these factors influence housing demand. And in a high-cost market, even small changes in demand can create noticeable effects. San Francisco is not collapsing overnight, but it is clearly adjusting. And that adjustment may take time. So what does all of this mean? Not a sudden crash, not a complete collapse, but a shift. A market that moved quickly, now slowing down. Some cities will stabilize, others may experience deeper corrections. But one thing is becoming clear. The era of easy gains is over. And in today's market, understanding risk is no longer optional, it's essential. If you found this breakdown useful, stay with us for more insights into real estate and economic trends. Because in a market like this, the right information doesn't just help,